Hey, it's Jim, and this is level 3 of the CFA program, the topic on portfolio management and wealth planning, and the learning module on portfolio performance evaluation. And this is part 2. Let me just quickly remind you that back in part 1, we spent some really good time on return attribution. Remember, we did the BHB model and the Carhart model. So what we're going to do now in part 2 is extend that to risk attribution. Notice that's the first LOS that we'll do. But then we have, 4 or 5 LOSs on benchmarking. And then down at the bottom, those LOSs we'll get into specific risk attributions. Now, I want to give you a little background here. Remember what we did in return attribution? We essentially divided the performance into security selection and asset allocation. We're going to do something similar in the risk attribution approach. However, we're going to use some tools that we're familiar with going all the way back to level 1. Look down at the bottom there. We're going to do appraisal ratios. We're going to do Sortino ratios. Of course, we'll talk about Sharpe and Treynor somewhere along the line in here. And then that last LOS, I think it's a really, really good exam question. Evaluate the skill of an investment manager. We have 2 really good slides at the end of this slide deck. So I want you to go back to level 1 and think about what we did when we computed the return and the standard deviation of a portfolio. Remember how we decomposed the standard deviation of a portfolio into systematic risk and unsystematic risk. We're going to kind of do that here in risk attribution, but it's going to be on a kind of a different level. You'll see what I mean as we get to the end of the slide deck. So let's go ahead and start with this first LOS on risk attribution. And what I want to do is quickly call your attention to the indented diamond points. And this is really important. You need to make certain that you compare and are aware to distinguish between absolute and relative mandates. These are really, really good exam questions. So this risk attribution is going to identify the source of risk. So for absolute mandates, we're going to look at the sources of portfolio volatility. But when we compare to a benchmark, we're going to look for tracking risk. Sometimes it's called tracking errors. And you can do this. With country allocation, and you can do it with sector allocation. You can do it with any other kind of allocation that you can come up with. I think this is a really important slide here. I want you to get your camera out and take a picture of this. What I also want you to do is I want you, after you take this picture and after I'm done this slide, I want you to pause the video and go to the learning module. There are 3 questions in there, right in this section, in which you're given manager A and manager B and manager C, and you're asked, what type of manager do you think this is? And you got to make 2 decisions. So look down the left-hand column. You have to decide if the portfolio manager is using bottom-up or top-down or factor-based. And when you think of factor-based, go back to that Carhart model that we did back in part 1. And then the second part of the evaluation of the manager is whether we are using some type of an absolute risk or relative risk. So comparison to a benchmark. This is a really good slide. So I want you to read this slide, pause, and go work on those problems right in this section of the learning module. Now there's a general section that follows those 3 problems. Did you go work on those 3 problems? And you should say, hey, Jim, thank you so much for making me take a picture of that. Now I'm going to be able to answer those questions on the exam like that. All right, so then there's a pretty general section here on the uses of benchmarks. So we're going to spend some good time here about benchmarking. Let me go ahead and remind you of what I did back in part 1. Remember, I gave you a 10-stock portfolio that we're managing, and then a 10-stock benchmark portfolio that had similar stocks. What did I call that? I used the term nearly identical. So the question then becomes, how and why and when do we use specific types of benchmarks? So liability-based benchmarks. So let's go through these quickly. We've seen these before, going back to level 1. Liability matching, funding status. This is interesting. Think about a pension fund that is fully funded. Think about a pension fund that is under or overfunded. And so depending on that status, we're going to have a different kind of a benchmark. I mean, imagine if you're hired as the portfolio manager for Jim's municipality. I'm some municipality in the United States, and I have a pension fund, and I say, here's some money. I want you to manage it. And oh, by the way, we have 1 million people who are retired. And so you have a small amount of assets and you have a huge amount of liability. So there's a tremendously underfunded plan. Well, you're going to pick a different benchmark than if I gave you this much money, right? And we only had 1 retired worker and 3 people working. I mean, that's pretty much unreasonable and unrealistic, but make certain that when you get to a question like this on the exam, you look at that funding status. And then, of course, you need to make certain that the benchmark is tuned in to what those liabilities are. Liability-based benchmarks, of course, should be used in conjunction with a total risk management. Remember how we talked about this back in level 2? Risk management is kind of like an umbrella, and lots of things. Maybe there are these silos, maybe they have correlation coefficients between and among them. And so this whole risk management process as it relates to the benchmark. And then, of course, you need to provide a standard. There's continuation of the entire balance sheet. So in that first one here, let me go back here. So liability matching, you're just going to say, okay, I got these people working over here. I have these people retired if this is a pension plan, and I need to make these payments. But then if we say asset liability management, we go ahead and combine the liability. So let me go back here again. We combine the liability matching, right? But then we look at what we have over on the asset side. And this asset liability management, I mean, there's tons and tons of stuff to it. But the reading doesn't go into many details. Helps us make informed investment decisions. If we know everything that's on the right-hand side of the balance sheet, plan structure, understanding. And then, of course, there's always somebody else involved in this, and that somebody else involved is typically some government or government agency that says something like, you know what, there's a law out there that Congress passed that said if you owe those people $100, then you better have at least $100 on the left-hand side of the balance sheet. So make sure you're aware of some kind of regulatory issues. Now, asset-based benchmarks, these we've talked about before. So market index benchmarks, security specific one. That's the one that I was just talking about with my 10 stocks and these 10 nearly identical stocks. And then you can have a strategy specific benchmark. I mean, let's suppose that I'm some kind of a portfolio manager and I say, hey, send me your money. I'm super smart, although I can't say that, right? I'm not allowed to say that according to the code and all the professional standards. But I say something like, look, I'm really smart, and what I have is I have a proprietary model that allows me to identify this one particular factor. You know, maybe it's inflation, maybe it's GDP, maybe it's credit spreads, whatever that factor is, and I'm smarter than everybody else out there. So I've got to tailor a benchmark to match, my little proprietary trading. Now, of course, I don't need to tell anybody about the benchmark. I can just say, hey, this is an appropriate benchmark. And we'll have some slides that tell us about good benchmarks. And maybe I'll go ahead and remind you about that particular comment. So we can have style like growth or value. Didn't we do that back in the Carhart model? And then composites. These are for multi-assets or diversified portfolios. And then, of course, we can always just customize a benchmark, just like we can customize a derivative security. We can customize, some kind of leveraged investment. We can do the same with a benchmark. Peer groups, we can always look over there and say, you know what, those people over there, they look a lot like us. Let's just use that. Or we can use factor-based benchmarks. But let me go back here real quickly. So what did I say here? This strategy specific was that example. So part of that could be factor-based. Here's the slide on the tests of benchmark quality. So no matter what kind that we pick, here I'm not going to go back and remind you of all those different types. It needs to be specified in advance. We can't look backwards and say, oh, you know what? If I put the benchmark and I say, oh, here are some details of the benchmark, then I can always make myself look as a better performer. Has to be appropriate, has to be measurable. I love that. Has to be unambiguous. You know how whenever you look at your phone or maybe turn on the television set and you see a politician out there, and a politician is never unambiguous. Reflective of current investment opinions, that makes sense. Accountable. Remember we did that whole thing back in part 1 of accountability. Well, that flows through this in part 2. And then, of course, the portfolio must be investable. You know, if you remember when back in level 2, whenever we talked about leverage and margins and collateral, I regularly use the example of the Pink Panther diamond. And if you use the Pink Panther diamond as collateral, well, you could probably do almost anything that you want. But if you have an investment in the Pink Panther diamond, there's nothing over there that is investable. I mean, a Pink Panther diamond, I'm pretty sure it was made up by by Peter Sellers and Steve Martin to make those movies. But anyway, you know, it's not investable. So think about the investability of what you're trying to do. And of course, this is way more important when we're customizing a benchmark rather than just saying, oh, let me take a combination of these 4 well-known indexes. Now this down under the green box here, this is a really important potential exam questions. All right, so scenarios. So think about the question stem. Managing intermediate duration government fixed income portfolio. All right, there's one scenario. Top-down quantitative equity manager. There's another scenario. Pension fund aiming to close the asset liability gap. All right, so there's a funded issue. So think about reading about this in the question stem, you know, purple, blue, and red, and among other ones that are out there. And the question will be something like, okay, let me just go back here real quick. Which of the following benchmarks is specified in advance, appropriate, all these kinds of things. So which one? You know, so we'll for the purple, maybe a broad market index. For the blue, maybe a factor model. For the red, maybe liability-based. I mean, those make sense based on what we've talked about over the last, what has this been, 5 or 10 minutes. Now, there's a really super interesting section in here that does some crazy things with math. If you look through this section, you might be thinking, well, what am I doing here? I'm just adding the same number. I'm adding 0 to one side of the equal sign. But this is really kind of a cool thing. So it's super interesting. So bear with me. So this is what the learning module does. It says, let's suppose the portfolio return is noted as P. So what we can do is we can put that into an equation. We can say P is equal to P. Well, that makes sense, right? We learned that back in kindergarten. But then, and this is a math trick going back to algebra, let's go ahead and add and subtract the same number from the right-hand side of the equal sign. So that's what we're doing over in the purple circle. We're going to add and subtract a benchmark return. So we're going to say P is equal to B plus, and then we're going to put parentheses around this, P minus B. So there's a plus B and a minus B over there, which means that we're not changing the equality. But then what we want to do inside of those parentheses is say, well, what is the return on the portfolio minus the return on the benchmark? Well, that's our active management. So skip down over on the left middle, we're going to denote that as A. Making sense? So we're substituting the uppercase A for P minus B and saying, hey, that's our active management decisions. And then we're going to do the same thing with the market index. We're going to add, over in the green, we're going to add the market index return, there's M, and we're going to subtract it, and we're going to put parentheses around it, and let's note B minus M. So what is that? The benchmark return minus the market return. Let's note that as S, and let's call that management style. So what we can do is we can do the little math. I mean, this is not even algebra. This is just adding and subtracting from kindergarten. So look down at the bottom left. We have P is equal to M plus S plus A, which is, so the return on our portfolio is compartmentalized into a market return, a style return, and an active management return. You see how we're going to use this model as some extra way of evaluating and attributing, right? This is called attribution analysis. Here's just a quick example. And oh, by the way, there's the equation in orange. You can solve for any of those four variables. Here, we're asked to solve for the return due to active management. You just throw some numbers in there and you get 0.7 based on the orange formula. So this is probably one that you should remember for the exam. P equals M plus S plus A. Market return, that makes sense. Style return, that makes sense. Active management return, that makes sense as well. Now, of course, what we've described so far is a scenario in which we go and we come up with a perfect benchmark. But what are the challenges here? And you know that the Institute loves to have LOSs that sound like, what are the advantages and disadvantages? What are the pros and cons? What are the good things? What are the bad things? So this one is called Describe the Problems that arise in benchmarking. Now, what the Institute could have done is had the period right after the benchmarking. But what it does in this section is extend this to alternative investments. So we've got this universe of alternative investments, things like hedge funds and derivative securities and private equity and collectibles and all those things that don't fit into what we've talked about so far. So what was I just saying? That we could have stopped and said, describe problems that arise in benchmarking. And these things here apply in general, maybe not to equity specifically and fixed income specifically, but if we extend it to alternative investments, then it makes perfect sense. So here we go. Limited investable market indexes for, things like collectibles or private equity. There's tons and tons of leverage in the alternative universe. Limited liquidity. That word liquidity, it's tossed around a lot. And from my perspective, it typically means, do you have some cash in your back pocket for whatever reason? Maybe it's an asset reason, maybe it's a liability reason, maybe it's an equity reason on the balance sheet. But do you have cash in your back pocket? Now, of course, in the alternative investment universe, there's not a lot of cash in the back pocket when you go ahead and invest in Hollywood memorabilia. And then lack of market values. I use the example all the time. You guys know that I'm a gigantic James Bond fan, but somewhere in the late 2000s, I came across a listing on eBay where the swim trunks that Daniel Craig wore as he was coming out of the ocean in that great movie Casino Royale, those swimming trunks were on eBay. Now I'm just guessing they were the actual ones for $18,000. So that was back in, let's say, 2008 or 2009. I wonder what those things would be worth today, now that Daniel Craig has retired from the James Bond movies. Who knows? I mean, maybe they're worth $1 million. However, if we were trying to benchmark the James Bond swimsuit, I don't really know how we would do it. I mean, I guess we would come up with a portfolio of swimsuits that have been worn in Hollywood movies. I don't know how you do all that kind of stuff. I mean, maybe you just track it on eBay. But you see, what's this one? Understanding the complexities. And of course, that's kind of, maybe an interesting or a popular example. But the same thing holds true for hedge funds and private equity without the Hollywood sex appeal, so to speak. All right, so let's work through some specific issues of benchmarking problems. All right, so hedge funds. A hedge fund manager could say, here, send me your money, I'm going to do this. And another hedge fund manager could say, send me your money, I'm going to do that. And those are the exact opposites. It's kind of like the George Costanza. Remember the one day he said, every decision I've made has been wrong. I'm going to go ahead and do the opposite. So how the heck do you come up with a benchmark when you have two hedge funds, and they don't have to be just two, there could be 100 hedge funds? How do you benchmark that? asset allocations, they change over time. And not only do they change over time, but we as hedge fund investors, we pretty much don't know what those varying asset allocations are. We probably don't know what they are today. We probably don't know what they were last month. We probably don't know what they are going to be in a month from now. Tons of leverage, which includes things of short positions and derivatives. And then I've been saying this here, lack of transparency, I implied that, and liquidity. All right, so what about the unsuitability of broad market indexes? Well, this should make perfect sense based on what I was just saying earlier, mismatched characteristics, and then probably zero correlation between and among all these things. How about if we use the risk-free rate of return as a benchmark and then add some type of a spread? Well, that makes pretty good sense. So, what is the 1-year Treasury yield? Well, if you go back to 2013 or 2015, I don't know, what was it, 2% back then? If you go into the 2020s, the early 2020s, it might have been 1 or 2%. And then after lots and lots of inflation, maybe it was 4%. I don't know that it ever got up to 5%. So you have some changes in that risk-free rate. And then what kind of a spread do you use? That spread has to be a function of the risk level. And so how do we know what the risk level is? Let me go back here just quickly. How do we know what the risk level is if the fund manager is doing all this stuff? We would have an idea, but can we capture it? Remember one of those things was measurability. And so the idea here, and this is what the Institute emphasizes in this learning module, that last arrow point, it may not capture all systematic risks. Yeah, that's a mouthful right there. Yeah, so what if we use this hedge fund manager universe as a benchmark? Well, there are all sorts of biases in there, not least of which is survivorship bias and self-reporting and limited representativeness. That makes sense. How about if we skip over to real estate investment benchmarking? Yeah, wow, what are we doing here? So you think about the diverse real estate investments that are out there, from owning an apartment building, owning a post office, owning a mall. Does anyone go shopping in malls anymore? I sure don't. Owning the land on which a grocery store sits, or how about land on a casino or a miniature golf course? What do we have? So look at some of these problems here. A benchmark is not going to fully capture the entire real estate class. And what did I just mention? 5 or 6 of those. So that makes sense. Yeah, the index performance closely aligns with returns from largest fund data contributors, right? So there's probably a high correlation inside of that green box. There's probably some biases there. Maybe the returns are skewed. We've seen this. In fact, one of my classmates in graduate school did his dissertation on real estate. And back then I had no idea about any of this kind of stuff. This is 100 years ago. But I do remember him talking about the importance of skewness, and that always stuck with me in his dissertation. And I used to say, wait a minute, weren't we taught in class mean and standard deviation, normal distribution? Let's just leave it like that and move on with our lives. But you can't do that, right? Because the world of returns doesn't typically follow a normal distribution. So just remember skewness in there, and maybe kurtosis as well. And then look at this, costly cities. This is so important. Of course, real estate in New York City is different than real estate in Des Moines, Iowa. I have no idea why I picked Des Moines, Iowa. So I'm guessing that the Institute would probably not have you identify what are costly cities to live in unless it said New York City, right? Or Tokyo or some other place. But if it said Des Moines, Iowa, or Memphis, Tennessee, or Anchorage, Alaska, I'd have to scratch my head and say, yeah, I don't really know how expensive it is to live in those cities. But it's probably less than New York City. So the Institute is likely to say, this particular city costs this amount, and this city over here costs this amount. So you'd be able to infer. Yeah, valuation changes. In our local newspaper, we have a monthly reporter who tells us what the housing prices are doing during so he looks at all the sales during the previous month and says, oh, home values are increasing, home values are decreasing, and so we these valuation changes. Sometimes it's a good market, sometimes it's not. Of course, all you got to do is read the newspaper to see, oh, yes, Ed over there sold his house to Jen over there for $227,000. So you can get that availability of transaction-based, and then you can put that together in an index. But, of course, it takes a lot of time. Yeah, some benchmarks are unlevered, some are leveraged, and there's all different sorts of types of leverage, so you got to be careful of that. And, of course, real estate indexes have all of these limitations inside of them. Yeah, how about private equity? We know that there are a handful of benchmarks that are out there. Some of them are better than others, but none of them are perfect. So there's this public market equivalent methodology so that we can compare with publicly traded equity indexes. But there's problems in valuation methods. What do we use? Do we use cash flows? Do we use operating cash flows? Do we use free cash flows? What kind of a discount rate do we use? Do we throw in some kind of cap rate? Do we consider internal rate of return? Do we use beta? Do we use risk-free rate? How do we use that? So look at the middle one in there. This goes back to the real estate thing. We all love the internal rate of return method because it is a geometric tool. However, what happens in the internal rate of return method, unless you use transaction-based every single time, those early losses, if you use just a yearly return, those early losses, they may skew the reports. Commodity benchmarking, we see this all the time. If you watch any of the financial news networks, there's something going across the bottom. Maybe there's the volatility index. Maybe there's something else out there for futures contract index or put option index. And so these are out there and they're pretty good to use. Some of the assumptions behind it are that, whatever those returns are, that you can replicate them. And sometimes you can, sometimes you can't. Because remember, when you're investing, let's just take futures contracts. You have all of these choices of rolling over a futures contract. Do you want to roll it over early? Do you want to roll it over late? Do you want to rely on convergence? Do you want to wait to the very last second to do all that stuff? So replication there is important. Market cap weighting issue. You can't really do that with commodity futures indexes because you can go and you can weight your investments, however you want. And so to kind of extract out that unweighting is difficult. Challenges in benchmarking, so representation, variations, and leverage, discretionary weighting. So we talked about those kinds of things. Yeah, how about managed derivative benchmarking? This is another challenge. Let's go ahead and look at some strategy-specific benchmark. Maybe we just always take the long position. So think about all the futures contracts. Just type in, you can do a quick search, Chicago Mercantile Exchange, and just look at the tons of futures contracts that are available. So maybe what we do is we have a proprietary model under which we just take the long position. We always know that we're always going to bet that the price goes up. So what we do is we say, okay, these are undervalued, and we do this. So strategy specific. Of course, you could have the opposite. You could have just short positions, or you could have market neutral positions. But there really are no market indexes that are designed to handle those kind of strategy. So what you got to do is you got to go ahead and customize your benchmark that we talked about earlier. Now, there is this Mount Lucas Management Index. What it does is includes long and short positions, not necessarily market neutral, like I was saying just a moment ago. But what it does is it uses some technical analysis. When do we do technical analysis? We did that at length back in level 2. And then you can use peer groups, but they're subject to survivorship bias. How about distressed securities? Another one of my friends in graduate school wrote his dissertation on trying to predict bankruptcy and looking at bonds, the price of bonds that are issued by firms that are nearing bankruptcy. So what are the problems here? Nobody really wants to buy these things, and those that do, I mean, as you know, there's a huge market for buying these distressed securities. But when I say huge, I mean it's this big, but the regular bond market is this big. So they're not quite as marketable. They probably have no liquidity, and that liquidity is not stable. And sometimes they don't sell for days or weeks, so stale pricing, and so it's difficult. It's difficult to value these things. There is an index here, the Barclays Distressed Securities Index. It's a potential benchmark, so it might not fit every strategy, but somewhere in the question stem, the Institute would have to give you an indication of, here's the strategy and here's the benchmark. And so if this distressed security index contains a bunch of securities that sound like they are inside of the portfolio, well, then it's appropriate. Now, there was a dude named Richard Roll who wrote a paper after the capital asset pricing model paper was published by William Sharpe, criticizing the simple fact that the market portfolio was unobservable because it ought to include every investable asset that's out there. This was known as Roll's critique. And lots of stuff has come out of Roll's critique, not least of which is this benchmark misspecification. Of course, if the benchmark doesn't contain all those factors, I won't go back to that slide, but remember all those factors, right? Measurability and accountability. But of course, the benchmark has to be nearly identical. That's why I gave you that example with the 10 and the 10. And if it's not, well, then any analysis that you do, any analysis that is performed is probably going to be, look at number 1, performance misrepresentation. How about 2, risk misestimation, attribution analysis errors, and incorrect investment decisions. So the point of all this and the addressing of this LOS is that, if you spend a lot of time on forming the portfolio, you should spend a lot of time on forming the benchmark, because really you're just comparing yourself against something that is similar, has similar characteristics. Think about it. Just think about it in terms of second, third, and fourth moments of the distribution. You want that benchmark to be relatively similar, nearly similar. What did I say? Nearly identical. If it's not, then you have all these problems. And so I'm guessing that the Institute could ask a question where performance misrepresentation, risk misestimation, attribution analysis errors, wrong investment decisions, distorted incentive. These are 5 potential multiple choice answers. Now, I know you're only going to be faced with 3, but when you get to the essay part, you could go ahead and explain these kinds of things. So think about it this way. If the benchmark stinks, then everything else that we've talked about here so far in this section, that also stinks. All right, how about moving on to another LOS? And this is where we're getting down to the nitty-gritty of the risk attribution. So, importance of appraisal measures. Provide valuable insight, evaluate skill. However, we need to be aware of the limitations. All right, so what are these risk-adjusted performance measures? I said this earlier. I said Sharpe is going to have to show up sometime. Treynor is going to have to show up. Information ratio, and then the appraisal ratio. So we know about these from previous conversations. Remember now, what we're doing is we're trying to attribute our risk. And the way we do that is by putting something in the numerator, putting something in the denominator so that we can make a comparison. So here are the equations in the next handful of slides. I shouldn't have to remind you of what the formula is for the Sharpe ratio. Remember, we have portfolio return minus a risk-free rate in the numerator. So in Sharpe, what do we want? We want lots of numerator. In the denominator, we have a measure of total risk. Remember, total risk consists of systematic risk and unsystematic risk. So what do we want? In the denominator, we want just a little bit of the denominator. Now, let me pause. There's a comma after my sentence there. So think about this. Sharpe ratios, we want Sharpe ratios to be higher because we want lots of numerator and little denominator. But now what we're trying to do in risk attribution is we're trying to look at that denominator and say, is it worth the risk that we take to get that excess return in the numerator? Now, of course, Sharpe ratio is appropriate for actively managed portfolios because we're concerned about standard deviation. With Treynor, what we're doing is dividing by the beta of the portfolio, which means that we're assuming that our portfolio, our portfolio is well diversified. Remember our definition, going back to the capital asset pricing model and the capital market line and the security market line, is that a well-diversified portfolio is one in which unsystematic risk has been virtually eliminated. So only one component of total risk is relevant, and that's the systematic risk component. So Treynor, all we're doing is dividing by the beta of the portfolio. So we have the same numerator. So we still want lots of numerator, and we still want a little bit of denominator, right? The Treynor ratio, we want those things to be high. But what we're doing here is that we're comparing well-diversified portfolios. And of course, the problem with the Treynor ratio is that if we have a well-diversified portfolio, then the beta of the portfolio is going to be close to 1. I mean, maybe it'll be 0.97 or 1.08. It's going to be close to 1. The benchmark portfolio is probably going to have a market portfolio index. Maybe that has a portfolio beta of 1, probably has a beta portfolio of 1. And so Treynor ratios tend to be kind of coagulated, is that the right word there? Whereas Sharpe ratios, they can be all over the place. So this is the way I always tell my students. I think this is probably a good way for you guys to memorize. Remember, Sharpe ratios are appropriately used for actively managed funds. Treynor ratios are appropriately used for passively managed funds. Now remember, not just index funds, but passively managed funds. So you can move that beta in one direction or another, but you're probably not going to have a beta of, let's say, 0.3 or a beta of 1.8 when you're using Treynor. Now, of course, William Sharpe, he taught us a lot of stuff. Jack Treynor, he taught us a lot of stuff here. And you can imagine that the next step would be to come up with this information ratio. So in the numerator, what we're going to have is a similar measure of performance, but we're going to take the performance of the portfolio and we're going to subtract out the benchmark return rather than the risk-free rate of return. So in the numerator for Sharpe and Treynor, it's going to be higher than the numerator in the information ratio because we're always going, well, I shouldn't say always, we're most likely to become closer to benchmark return than the risk-free rate of interest. And then in the denominator, what we're going to do, instead of using either total risk or systematic risk, we're going to use tracking risk, which is essentially the standard deviation of the difference between the return on the portfolio and the return on the benchmark portfolio. And then continuing on with this extension, the appraisal ratio, we're going to go ahead and put alpha in the numerator. So once again, we want lots of alpha. And that can be defined in many, many different ways. But what the Institute does in this part of the reading, it says, let's take the portfolio return and let's subtract what William Sharpe taught us in the capital asset pricing model. So think about the numerator as the difference between the actual return and the expected return. And then we're going to divide by residual risk. And that residual risk, here, let me go back here. The residual risk is not going to be the standard deviation of the portfolio. It's not going to be the beta of the portfolio. It's not going to be tracking risk. It's going to be the result of a factor-based regression analysis and some measure of volatility. We'll call that residual risk. And then the Sortino ratio, look in the denominator. We're going to do the same thing we did before in the numerator. We're going to have this return on the portfolio, but then we're going to have a target rate of return. That could be like a minimum acceptable rate of return. It could be the return objective that we derive with our conversations with the client. Remember back in part one, I said to you that, suppose the client gives us $100,000 and said, hey, this and this and this and this and this, and we come up with a 10% return. We say, all right, you would be happy with 10%. There's a target rate of return, which in general is specific to each client. But now, instead of dividing by some kind of a standard deviation in those four previous tools, we're going to divide by the target semi-deviation, which is just downside risk. So think about this. Suppose we have a normal distribution, even though we might not. If we have a normal distribution, we're worried about everything to the left. And what we're worried about is shortfall. We're worried about things like value at risk. And so this, of course, leads into conversations of all of those extra risk management tools. So look down at the blinking 2 in the green box there, more meaningful for investments with non-normal return distributions. So even though I gave you that normal distribution picture, it doesn't have to be. And in fact, it's more appropriate especially if we got a steep slope and then we have these returns there, which are positively skewed. This capture ratio is really, really a cool thing. I would definitely be prepared for this if I were creating an exam question. So let me give you the background here. Let's suppose a client throws $100 at us. And what we do is we increase that by 10%. So we go from 100 to 110. And then at the end of that, now that was because of our decision making. But during the second year, we lose 10%. Well, now we're losing 10% of the higher number. That's $11. So our portfolio at the end of year 2 is all the way back to $99. Okay? Hold that thought. Another client gives us $100, and our decision during the first year, we lose 10%. So that gets us down to $90. But then the second year, because of our decision making, we increase by 10%. Well, 10% of 90 is only 9. So once again, we're at $99. So for both clients, where we increase by 10% and then decrease by 10%, or decrease by 10% and increase by 10%, we're still at $99 at the end of that second year. So what this capture ratio does is it asks the question, how effective is the manager in doing the following? Are you ready for this? So let's go to my first example. So we had 100, we turned it into 110. Then we have a down market. Well, what do we want to do? We don't want to fall all the way to 99. We only want to fall to 101. Our ability to manage the downside performance. Then for the second client, we fell to 90. And then in the up market, what we want to do is we want to get it up to 101 or 102. We don't want to stop at 99. So that's this capture ratio. Look at the blue equation there. The upside capture ratio and the downside capture ratio really just captures the manager's ability to outperform in up markets followed by down markets, and then outperform in down markets followed by up markets. Well, whatever direction those guys are doing. So there's the important thing. The blue equation is important, but then look in the orange over there. A ratio above 1 indicates positive asymmetrical return profile, which means that once you increase by 10%, then you're only going to fall by 7%. Or once you fall by 10%, you're going to increase by 11%. Now, drawdowns, of course, this goes back to our Carhart model, which we did in part 1. Remember, there was that fourth variable about momentum. So sometimes momentum is positive, but sometimes momentum is negative. So this is drawdown, maximum loss from peak to trough valuation, right? How many drawdowns can you have? If you stink in this period, then are you going to stink again? And then are you going to stink again? Are you going to stink again? So drawdown is that max loss. And then the duration is how long is that extended? So that's what these two things are. How about limitations of all of these appraisal methods? So they typically rely on historical data. And what do we know? We know, well, let's go back to level 1. What did we learn was that we learned capital asset pricing model, and then we learned some of the problems, which of course one of them is the rules critique, but the other problem is that beta is not stable, meaning that, if you compute beta over a 3-year period, it's probably not the same thing as it is over an 18-month period. And so using that historical data is probably not nearly as accurate as if we did some other model, right? And it might not, history is probably not going to repeat itself. So look at the dollar sign down there. This is what I was saying about beta not being stable because macroeconomic conditions are not stable, strategies are not stable, stock market conditions are not stable. So here's a little summary page. Choosing an appropriate benchmark is challenging. They might not fully represent, and inaccurate benchmarks can be misleading. Yep. So there's subjectivity in all of these risk measures. Subjectivity means that we can allow our personal viewpoints and our brain's mistakes to do things like subject to interpretation, varying results, not capturing all of the elements of risk. Now, what we've done in part 1 and so far in part 2 is kind of assume that we have performed this attribution analysis, both at the return level and the risk level, in a complete form. But it's really difficult to do a complete one. So what are we doing here? What are the consequences of having an incomplete attribution analysis? Well, look at that third teardrop point. This is, I think, the issue on an exam, potential exam question. Can mask the underlying factors. What are those factors? I mean, they could be anything. Inflation, value, credit spreads, all those kinds of things. Yeah, how about this? Lack of contextual information, right? Lacking of context. We hear that all the time when somebody says something on social media and they say, oh, well, you had to be there. You had to be there so that you could understand the context. And then they take, 100 hours to explain the context, and we're still not quite sure what they were trying to say. So what is the context of our portfolio, and how does it relate to the benchmark? Now, we need to make certain that somehow we take into consideration all of the external factors, but this is almost an impossibility. Just go back a handful of years to 2019 and how happy we all were during the summer of 2019. And in the fall of 2019, we started hearing about some stuff and we thought, well, that's not going to impact us. But then by the spring of 2020, all of a sudden, we've got this COVID falling down upon our heads. So the question is, how do you consider major external small probability events like COVID? I don't know. It's tough. It's tough. So here's my advice on the exam. When you get to the essay question and the institute says, hey, what are the problems? And your first sentence could be something like, this is tough. This is a challenge. How are we going to do this? Well, go ahead and say that, because the grader, I don't know anything about the grading, but if I'm grading this and your first sentence said, man, these are really challenging, and then just list the reasons that they are challenging. That sounds like a complete answer to me. Yeah, appraisal measures primarily focus on quantitative metrics, and there are other things that are out there, qualitative measures that probably go into impacting the performance, risk performance and return performance. And so we probably need to add some qualitative factors. Yeah, so how are we going to handle all of this? Well, we're going to probably combine a bunch of these things. We're going to probably conduct huge quantitative analysis, but we're going to complement that with qualitative analysis. And then look at the purple one. The Institute, they love this, right? So make certain on the essay questions that you always say at the very end, what we want to do is we want to monitor, we want to review, we want to update. No matter what the question is, the Institute is very clear in their repeating of an LOS that sounds something like, why should we review? Why should we monitor? Why should we update? And the answer should be obvious. Now, don't put duh, don't write DUH exclamation point as your essay answer. Go ahead and write all the stuff that we've been talking about. All right, so here's a good summary page of what we're going to do over the next handful of slides. What are we trying to do? A comprehensive analysis of attribution, return attribution, and risk attribution, which we call these appraisal measures. We need to make certain that we have risk, volatility, and performance relative to all of those benchmarks. So let's go ahead and look at two examples. So look at the LOS. Evaluate the skill of an investment manager. So here we are. We're given this Sarah Thompson. So what is she doing? The FTSE 100 is the benchmark. She's underperformed by 72 basis points. So if you read that in the question stem, automatically look at the table and make sure that at the bottom right, it has 72 basis points. So 72 there's the minus 0.72%. So that's so far so good. Now look, the Institute doesn't have to give you Thompson underperformed the benchmark by 72 basis points. You can get that from the bottom right of the table. So in this learning module, the Institute regularly says, hey, don't worry about how we computed this table. Just take it for granted. Learn how to interpret. Remember, there were a couple of Part 1 LOSs that were to interpret. Now, what we did is we put this on as an example because there's a really good example in the learning module of different countries. So this is what we have here. So you have this one and you have one in the learning module. So look at the last sentence there. What are we asked to do? We're asked to determine whether the underperformance was due to, did we stink or were we just unlucky? So let's go through some of these columns. Are you ready? So what did we do here? Here are our weights for UK, Germany, France, Spain, and Italy. And in the blue column, there are the weights. So what did we do? We underweighted Germany. We underweighted UK. We underweighted Germany. We overweighted France. We overweighted Spain. And we have equal weights for Italy. So clearly, the difference in those weights is going to have an impact over on the far right column, and then that's going to lead to the minus 72 basis point performance. But in order to have a better sense of where those numbers are coming from over on the right-hand column, let's go ahead and compare our portfolio return, or Sarah's portfolio return, and the benchmark. All right, you ready for this? So what did we do? We underweighted UK, and our return was less than the benchmark return. Okay, what did we do? We underweighted Germany, but our return was greater than the benchmark return. That's not so good. What did we do in France? We overweighted, and our return was greater than the benchmark return. Oh, that sounds like a good deal. What did we do with Spain? We overweighted, and our performance was less. Well, that's not that great of a deal. What did we do with Italy? Well, we had the same weight, but our Italian stocks, they underperformed. All right, so think about that. That's what's happening. That's what's happening inside. So if you get to this question on the exam, spend a minute and go through the columns like I just did. Then when you get over to the black columns, you won't have to make these calculations, although we did that back in the BHP model, right? But here we're given the entire table. So there are the allocation effects. There's, what is that, a -5? What are the selection plus the interaction? All right, so we're doing the BHP model, but we combine those two, and then the total effect is minus 72 basis points. So let's do the allocation effect. So what do we do? Allocation in our decision to over or underweight, that just lost us 5 basis points. But our selection of the individual securities inside of those 5 markets, that lost us 67 basis points. Now, of course, there's an interaction. What did I call that back in part 1? A kind of a spillover effect. So that leads us to the 5 and 67. Of course, they sum to 72. So here is a summary kind of based on what I just described, right? So we underperformed 5 basis points due to country weighting because of the over and the underweighting there. And go down to the purple, there's the 67. So the impact of the selection decision was way more significant than that of the allocation decision. So that last sentence down there, a summary, here, let me go back, a summary of what we just decided when we worked through the columns, the answer kind of presents itself. So that's probably what you would want to write on an essay question. Let's do one final quick example here. Manager A, B, and C. And there's the benchmark on the far right column. There we have returns. So what kind of conclusions can we make? Manager A had the highest return, but also had the highest standard deviation, had the highest Sharpe, had the highest Treynor, had the highest information, and had the highest Sortino ratio based on a minimum return there of 5%. So what can we do? We can go ahead and say something like, hey, Manager A, highest return. Manager C, lowest volatility. How did we do that? Yeah, standard deviation of 10.95. Manager A, highest risk-adjusted return by Sharpe and Sortino. There we go. All managers exhibited positive information ratios suggesting some level of outperformance. So what can we conclude? That these three managers, they all probably did a pretty good job. However, there are some discrepancies. So which one do we want to pick? Well, you're tempted to say Manager A, and that's probably the correct answer. But there might be conditions under which you would select other managers. So I think that takes us through all of the second group of LOSs. So what I want you to do now is I want you to take maybe 30 minutes and work through those 14 problems at the end of this learning module. There's a 6-question vignette and an 8-question vignette. And as I have looked through those and worked through the answers, I think you're pretty prepared to be able to get. Now remember, we're not quite sure what passing grades are, but clearly you ought to benchmark yourself against 70%. That seems to be what lots and lots of people say. So I'm hoping that you can get at least 70%. How about 80%, right? How about 90%? Hey, thanks for watching. Have a great day and good luck studying.